Why in the world would a lender take so much less than they just gave somebody to buy the house? These are the reasons why, and there's probably many more. This may not be an exhaustive list. But number one, are banks in the real estate business? No, they're in the money business, right? They sell money, they rent money, they give us 1%, and we give them all of our money, and then they give it back to us at 6% to buy a house, and 8% to buy a car, and 15% to get a credit card, and on and on and on, right? That's the deal that they've got. And so they like to rent money. Now they do have real estate they're very proud of, like skyscrapers in New York and Chicago and bank branches, and all that's reflected on their balance sheet as a big positive. What's not reflected well on their balance sheet is what's known as OREOs, okay? And as in not double stuff, not stuff you're dipping in milk. It stands for other real estate owned. Not the good real estate owned, the other real estate owned. That's that little junker down in Brownsville that they had to foreclose on, and now they're sitting on it. They can't sell it to anybody, and it's just sitting there, okay? That's bad news. And if they get too many on their books, it doesn't look good for them, okay, for some of these other reasons. Number two, the cost to foreclose. The average nationwide on most average priced homes of all foreclosures across the country is about $50,000 to $60,000 to foreclose. So let's just go back to our initial example. If it cost them $50,000 to $60,000 to go through the whole foreclosure process, right, and that they're owed $150,000, but you're willing and you're coming in way early before it's even started foreclosure, and they're not going to have to pay the 50 or 60. Wouldn't it make sense for them to just go ahead and take your offer for 100 and save that 50 to 60? And basically they're even up as opposed to going through the foreclosure, right? So the cost to foreclose is something that is a mathematical situation for them. Say, hey, why don't we just go ahead and take this offer now and not have to go through this process of this person going into foreclosure? Number three, liability and risk. Back in 2008, 2009, 2010, I know my dear friend Les would know about this. I'm sure my friend John Priller would know about this. Anybody who was active in the real estate knows there was a big industry that was booming during the foreclosure crisis called property preservation. And there was all these people doing, contractors, many of them, who didn't have any business anymore because builders weren't building and people weren't renovating. And these contractors became property preservation specialists, and they went around to all these vacant homes that people had abandoned and had left because they were going through foreclosure, and they were in charge of making them safe, right? They were putting cages over the pools, and they were changing the locks on the doors so people wouldn't come in and vandalize, and squatters wouldn't be coming in, and people wouldn't be stealing the cabinets off the wall. There's a lot of risk and liability to a vacant house just sitting there. Somebody walks on the property, falls in the pool, and drowns. They're going to sue the owner, who is broke and is leaving the house is foreclosed on, and they're going to sue the bank, and they're going to sue everybody they can find, right? And so there's a big risk of them just owning real estate or having real estate they're responsible for. Number four, obviously, most of you guys are familiar with compliance as far as like FDIC. If they have too many real estate owned properties, if they don't sell them within a certain period of time, oftentimes they can put at jeopardy their FDIC insurance from the government. So they don't want to do that, because if your bank ever is not FDIC insured, everybody's going to go and pull their money out of the bank, and the bank's going to collapse, right? So they care about that. Number five, the very last one is everybody in a big bank understands that basically everybody's compensation is tied to the stock price, right? So the way Wall Street responds when they look at a balance sheet or they look at a bank's books and they see that they've got all this real estate owned property, that they're getting, close to having some issues, they're taking back all this bad debt, that drives their stock price down, that hurts the CEO's pay, that it hurts everybody's 401k, et cetera, et cetera. So there are a ton of reasons why the bank would not want to take back too many foreclosures and make a deal with a buyer who's ready, willing, and able and has cash in their pocket to buy a short sale in order for them to just take less than what is owed on the property in order to get this property done, clean, off their books, take that cash back in and re-loan it out on somebody who is actually paying on the loan, okay? Taking a toxic asset or a toxic debt, an unpaid debt, and turning it into a good loan. Does that make sense? Right? So that's the reason why banks would be motivated to possibly take less than what is owed. Let me give you